Hey everybody, David Skarika here. So about to do a video here. You can see it's night in my house, but it doesn't really matter because most is obviously is going to be screen shared. Um, so it's nice to not have to worry about the lighting or how you look. Both which sometimes are not great. But okay, so here we go. Yeah, we're back in action here. Like I don't want to apologize, but I just want to say thank you for those, longtime subscribers. I explained this quickly on the interview I did with Mike Swanson. I've been doing this for 25 years. I started my newsletter when I was the month before I turned 21. It was late August of 1998. And actually, I didn't go to university, and I started doing stuff in the financial industry in 1996. I'm having reminiscence right now of that. But anyhow, so you're talking 27 years, 20, 25 nearly doing a newsletter in some shape or form. And it was just like after last year, we did a lot of option trading. It kind of ended up with a whimper. Oh no, not really, because Eldorado was my last trade of last year and I did well. But so essentially, sorry, I just got my thoughts together. Home Capital Group got taken over. It was basically a bailout. That's what really was going on. But anyhow, and I did well for the most part. I still made out ahead in option trading last year because we were in and out of a lot of positions. We were bearish. And then about October, I saw the sentiment getting bad, and then I could tell the market just wasn't going down anymore. And I was like, I'm not as bearish for the short term. I want to get out of this. I was waking up in the, I'm doing this late, but like it was getting bad where I was getting up in the middle of the night, just looking at positions all the time, getting insomnia, getting the blue bags under my eyes, all this sort of thing. And I was just like, I got to take a break from this because option trading is quite stressful because it's not like stock trading where you can just buy the stock, set your stop loss and whatever, or just whatever, buy a small position, add to the position, the stock goes down, etc. So we're going to talk about this, what Wish is about in a second here. But anyhow, so I was just like, I need a bit of a break. And I was also I was setting up what I want to do now, which will really start probably really get going in April, but definitely start next week where I'm going to do a small daily video for the free list, and then have now that I think that gold and silver have really turned around, talk about some companies I like, et cetera, et cetera. So we'll get into it. So again, like I said, thank you. Essentially for those of you, this video is going out to everyone because I think it's really important of what's happening right now in these banks. But like for those of you who are paying subscribers, I'm gonna have you all upgraded up to like the highest subscription point till the end of April to make up for the fact of what happened the last few months. But again, like I like to say thank you, everyone. I don't know if some of you are gonna crap on me because of that. And look, there's another reason too, and I'll get into a bit of a rant here before we start. Part of the reason is I still like financial markets. I still like finding undervalued companies. I still like, taking part in private placements, all that sort of thing. But I have to say, I don't like have that ultimate passion for it like when I started out. And I think all the bailouts, the QEs, all of this stuff really just has me more jaded, because it isn't a free market anymore. It is really crony capitalism. If you want to go into a big, huge macro picture, I think, everything going on in the West is almost like an empire on its last legs because it has gotten so corrupt and the whatnot. And, we'll talk about the Silicon Valley Bank in a second, but, even what happened here in Credit Suisse. So you can see that Credit Suisse collapsed. This has been years in the making. It's actually amazing because people have talked about Credit Suisse and Deutsche Bank. I've talked about it once in a while too. For years, this is like the chart of death, as I usually call it. Like, I believe in maximum pessimism and trying to buy assets cheap, which we'll talk about. But like the problem with banks are so leveraged is that when things go bad, and we saw this obviously with Citigroup and, and obviously the ones that failed, like Bear Stearns and Lehman, that's the problem. Or if you go look at what happened to the banks in Greece, when a lot of the assets they own got marked to basically zero, and Greece had a pseudo default on its debt in 2012. The problem is banks, they're so leveraged, and then to recapitalize, they have to really like, just dilute themselves to hell. So banks are probably not the best companies to do that. And I'm going to show you this right now. Greece. Kind of funny. Wish came up. I just had an email. That email that came in was actually an advertisement for Wish advertisement, because I do have an account with them. So maybe that's a sign. And this is the National Bank of Greece. So this is going back. You can see back to the 90s. You can see this thing adjusted for the reverse splits and the whatnot. It was like, we can't even see this because it's so crazy. But it looks like it was like $40,000 or something, and now it's $4. So it's basically down 99.99999%, right? So that's the funny thing, and it just shows you, like, if you had said in 2012 or 2000, this is when the Greek crisis happened, okay, you got a little pop here, but then they had to keep diluting, and you can see what happened in late 2015 too. Maybe now it's a good, it's so beaten up, it is a good pie, but like, it just shows you that's the problem with these bank plays. And, that's the problem. I know that City CS is talking about selling off assets and the whatnot, but that's the issue right now, is that probably if they were to stay alive, they did get a loan, but at some point they're going to have to do some kind of equity to stay alive even more. And the problem is they'd probably send the stock down to 2 cents with all the dilution, and then do a reverse split, 1,000 to 1 to get it back to, to get it back to $20 or something, right? So anyhow, so we saw what happened. Is really amazing what's going on in Switzerland. No one's really talking about the Swiss central bank's balance sheet, because they have this thing where they were basically buying stocks with printed money, and it was great for a few years because they were buying the Apples, the Amazons, all of the quote unquote usual suspects, the big tech stocks, and of course they lost a lot of money in those. So essentially, they estimated to have lost $140 billion, and then they just loaned over $50 billion to Credit Suisse. So let's say, for lack of a better, let's just round it up to 200 billion, right? That means the Swiss economy is about $800 billion, right? Because Switzerland is not a big country. It's a rich country, but it's not a big country, right? And so they've basically spent 25% of their GDP, the central bank, either losing money in stocks and loaning out to Credit Suisse. And that's another problem too, is you also have UBS, and obviously that one's solvent. And so they only have they have these, obviously they have a big banking sector in Swiss, but those are their kind of 2 mega banks. But the difference is between like the financial bailouts in America, remember the TARP was 700 billion, like I just said, the Swiss economy is 800 billion. Switzerland is not nearly as big as the whole Eurozone, and it's kind of financially still independent of the Eurozone, right? They still use the Swiss franc, they have their own central bank. So like, that's the problem too with these bailouts, is that these Swiss banks, because we all know Switzerland is a tax haven and banking haven. Their banking sector is outsized in comparison to their economy, so that they don't also have the resources in the economy. They don't have a $20 trillion economy like the Eurozone, like the US, to do all these bailouts, right? So anyhow, and it's not a loan. We all know Credit Suisse cannot pay back that money. So, and like, there's other things too that I read that recently, that they're looking, the Bank of England is looking at $200 billion losses. How many of these central banks, they've lost trillions because they were doing QE. Like, let's just quickly look. Let's just make this simple. Let's look at the TLT, right? And let's go back 10 years when they've been doing all this QE. A lot of this QE happened in like 2013, 2014. You can see the bonds are essentially flat since then. And a lot of the QE happened during the 2020, COVID crisis. And you're talking, these bonds are down 30%. So these central banks have lost trillions of dollars on these bonds. And at some point, the taxpayers pick up that bill? Do they just probably more than likely just print money and paper it over? I guess they can keep rolling over because they are bonds. If they bought a 10-year bond and they're down 30% on it, they could just, roll it over at some point, so I don't know how that works. I'm not going to try to figure out how that works, but I think that's why too, we will not see that form of QE to inflate asset prices. The only way you could see a QE like that to buy government bonds is if we get a sovereign debt crisis, and they have to keep interest rates low because the government just can't afford the debt. But I don't think there's anything going to be targeting asset prices. I think the central banks, one reason, you saw Eurozone increase 50 basis points, even despite the Credit Suisse thing. The Fed still looks like they're going to do another 225 basis point increases in the coming months. So I think one reason you're seeing this reluctance, other than emergency loans to banks, I think you're going to see this reluctance to inflate asset prices again, because I think they realize they failed. Like one reason we're seeing this is that a lot of these banks are now having to mark down the value of the assets they loan, right? Real estate. Obviously, there's going to be more foreclosures on houses, so that means their loan portfolios won't be doing as well. Obviously, a lot of them, especially these ones that are based in Silicon Valley, like Silicon Valley Bank, probably did a lot of tech investments, investments in tech bonds and tech companies, etc. And that's why these crypto banks like Silvergate, collapsed so precipitously, sorry, because they owned crypto assets, which of course Bitcoin is down from over 60,000 to 24,000, and that's the quote unquote most stable crypto. So we've seen all these issues and problems and the whatnot. So the thing is about it, makes you really kind of sick to your stomach though, is this is the Silicon Valley Bank, and and what makes you sick of it, first of all, why did this get taken out here? We just showed you the chart of Credit Suisse. Lehman and Bear Stearns basically went to zero. Lehman went bankrupt, Bear Stearns when they got bought out. Why was this taken out so early? You could argue because obviously they didn't want a bank run, but you could argue still $106 a share, even if it's on its way to 10 or 20. The reason being is this. You keep hearing, they want to protect the depositors. When we hear to protect the depositors, we all see that as a positive thing, because we all have, whatever, I don't know what your financial situation is, but you might have anywhere from a few $100s to a few $1,000s to maybe tens of thousands or even hundreds of thousands in a bank account somewhere, right? And when you're protected depositor, it's it's the average mom and pop, or me or you, and we got 5 or 10 grand in the bank account and our credit card, or our mortgage is there, whatever it may be, right? So those are the people you want to protect. But Silicon Financial is SVB. Most of their clients were big Silicon Valley based tech companies. They were companies that had any tens of millions to hundreds of millions of billions of dollars. And one reason the run was so easy to precipitate was they didn't have millions of small depositors with hundreds or just thousands of dollars in their account. They had a bunch of companies, which are the majority of their deposits. And when those were pulling out, the bank was insolvent. And what I'm trying to say is the takeover and essentially de facto bailout. So it's not protecting the deposits of the mom, Joe, whatever, Joe Six Pack or whatever you want to call it. It's protecting the deposits of these big, huge tech companies, right? So it's BS. And this is part of the reason I just said earlier, financial markets make me shake my heads now in this crony capitalism, because some small Midwestern bank in Oklahoma or Texas or Kansas is going to go down, and they ain't going to do nothing. But this thing has got all our cronies are in there, right? If you go look at the board of Silicon SVB, it's big donors, people that used to be associated with high-end politicians, and they're going to get this preferential treatment. So it's just really disgusting the way it's gone. And I think at some point when it will basically end, and the ironic thing is how well tech stocks did today, by the way, with like I said, the tech stocks kind of being epicenter of this kind of current banking crisis. So this is the regional bank index, and you can see how this tanked. It did bounce today. It is oversold. It could bounce a little more. But here's the issue. Now we're going to have the trickle down effect. I don't think this is just easy as, look at, we've gone down for really what? Not even a month. Basically, the large decline started, a week or two ago. You could see 110 was support on the regional bank index. It broke that about a week ago and then fell from 110 to as low as 90. So fell almost 20% in basically a week. I don't think it's that easy, because remember, there's all these other factors that are going to happen now. When you, like, Regions Bank was one that they took over. Wall Street put 30 billion into the other banks, and they said they're going to sell off the assets. But the problem is, and this happened in England when they took over Northern Rock in the financial crisis, everyone then puts their money actually into this bank because they're like, oh, this bank's being backstopped. All other Wall Street firms are coming in. Oh, the Fed is bailing out this one. And then that causes failures at other banks. And then also, quite frankly, and this is why I really like the home builders, KBH is one I did today, or, bought some puts on. I really like these as shorts because right now, because of whatever, the bond has rallied, interest rates have come down. There seems to be an algorithmic trade on where, you can see that the bond yield, which peaked in October at 4.20, has come down to about 3.60. So that means, a lot of mortgage rates have come down 0.5% to 0.75%. So they kind of trade with that. That's why you can see KBH bottomed here and has had this rally, from the mid 20s to the mid 30s. It's a nice 40% gain. And that's with the housing market slowing hugely. It's because a lot of funds just buy thinking, okay, lower rates on the long end mean more demand for mortgages and buy home builders. But as we saw in the financial crisis, I don't think these rates matter anymore. When you're having this, these banks aren't going to be loaning money, right? These banks actually will either take that money they're getting from the Fed. I'll talk about that in a second too, what they're actually doing, put that in treasuries, get their 5% to rebuild their balance sheets, right? Or just sit on cash, because they're not going to be wanting to take any kind of risks. And risk is loaning money loaning money to somebody for a house. So what the Fed is essentially doing is, let's say we're going to show you, this is one of the banks that really tanked, rebounded a bit, Western Alliance Bank. Let's say Western Alliance Bank owns a bunch of bonds, or a bunch of whatever they may be, tech bonds, bonds is government securities. I showed you what the TLT did, and the whatnot. So what the Fed is essentially doing is taking those bonds off their balance sheet and loaning them cash, but the Fed is marking those bonds at 100. So let's say they own a government bond, you buy the coupon at 100, but now it's worth like 80 because interest rates have gone up and the price of the bond has gone down. The Fed is loaning them that money at 100, or taking those, and taking those bonds themselves, buying them essentially at 100 and taking the loss. And that's how they're kind of recapitalizing these banks. And so that's ridiculous, right? So the Fed again is kind of taking on the loss, the whatnot. So that's essentially what's happening. But the issue with that is, again, they're not going to want to, we're going to loan money to this guy who may default on the loan, or turn around and do risky investments that can fall 20-30% with that new money. No, they're going to say, well, we're getting actually 100, for these bonds that are really worth 80. We're going to turn around and take that 100 and just, get our 4 or 5% in a short-term treasury, which doesn't trade, just like the guarantee, principal, and then you get the income, or the dividend or interest. So that's essentially what's going to happen. So that's the thing is, you look at these home builders. There's another one, Lennar. It's kind of like, you see, Lennar was up 4% today, and the Lennar's one reason I like KBH. KBH a much weaker company. So, but anyhow, you look at these home builders, and it's like, who really cares that rates are going to go down? Because these people aren't going to get financing for homes now. And the thing about home buying is, okay, we all know that the big Wall Street banks, JP Morgan, Goldman Sachs, etc., they do most of the, obviously, venture capital and trading and all this sort of stuff, underwriting. But a lot of mortgages are still created and still lent out from the smaller regional banks. So I just think that's going to kill the housing, market even more. And here's the housing start numbers, which you can see there was a jump in February, but I would think that's going to fall right back now in March with the banking crisis going on. You can see that jump is off a low level, but you can see still not like a terrible level, but you can see the housing starts have gone from 1,800 at the peak in early 2022 went down to about 40% to almost 1,300, and now we're back at 1,450. So you can see, the issue we're going to have here is I would think that these housing starts now will go down even more, regardless of what interest rates do. Because remember, too, with the banks lending less, that means if there's less home construction, that's less jobs than that. We're going to see, obviously, with this, a lot of this being at the heart of a big bank in Silicon Valley, I think we're going to see even more layoffs in the tech sector, and those are big, high-paying jobs. So I definitely think, and like that, this is going to lead to recession. Like I said, to me, it's a way too easy that Silicon Valley Bank went down, Regions got bailed out, Credit Suisse just got, we remember the financial crisis. These things kind of build and build and build. And, like the S&L crisis was the same way. And, I saw a chart of Mark Haloesco on, who's lives in the Bahamas, is Bahamian actually. On his Twitter, right here. Bank failures tend to start quickly, but take a while to stop. U.S. bank failures by year. You can see the financial crisis. 2007-3, blah, blah, blah. I don't need to read them all, but you can see that basically there were bank failures all the way into 2015 after the financial crisis. So to think that, like, if we are kind of where we were in 2007, to think that this is probably just going to end this year is probably sadly mistaken. And like he mentions too, most of them are small banks, though. Obviously Bear Stearns and Lehman basically failed. And actually Bear Stearns even technically failed because they were taken out for whatever, $3 a share. But this is essentially what's kind of going on here, with this. So, and I just thought I'd just leave it at that. So look, so let's get to the more positive side here. I don't think I'm going to really talk about gold and silver in this. I do think, okay, let's just do quickly on gold. I think gold is looking very good. You can, it did fall a bit today, but it's right back near the highs. Obviously, the stock market, we're just to take off and go to new highs. But I think what we're looking at now is one or two more 25 basis point increases. And then, excuse me, I'm sorry about this. Just my sinuses are a little stuffed up. Anyhow, we're looking at, excuse me, another, this and and then that's really a good backing for gold, like good wind in the sails, as they say, right? You can see silver's come off too. And what's great is if we look at, because of, gold stocks are a little more affected by liquidity. Oh, sorry, I did an accident. I screwed up there. Yeah, you can see the GDX, came off pretty good, 33 to 27. That's about a 15% decline. Has not rallied nearly as strong as gold. I don't really see that as a leading indicator. I see the issues in the market kind of having been a bit of a problem there. Like today, for example, you saw gold was down pretty good, and the GDX, kind of came off its lows. So again, that liquidity factor. So partly because the stock market was strong. So anyhow, I definitely think this is great. And like the great thing is, I do a lot in the junior mining sector, and we're gonna look at the CDNX. And you can see the big down move here, and the juniors are still very, very depressed, and most of them are not moving on good news. And you're getting gold, like I said, at nearly 1,900 to 2,000, and this sort of thing as well. So, and remember, they're talking about doing basically printing another $2 trillion to backstop the banking sector. So again, and with them raising interest rates, probably at the May meeting, I think that all helps gold as well. So, but anyhow, here's what I wanted to do. So my strategy is now, we recently, I just bought some puts on Crox. Crox was actually up, but whatever, wasn't up huge considering how much the market was up. I think Crox is topping in here. And one reason I like Crox as a short, let's go to this. You might say, why, Dave, in a financial crisis, do you want to short, plastic shoe company, right? Well, if we go look at Crox here, this is a great boom and bust stock. Now it went to, actually, I need even longer here. What's the 18-year chart? You can see it went from over 70 to $1 during the financial crisis, back to 30, and then basically spent 5 years falling to about $5, then rallied to 40, fell to under 10 in 2020, and blew off to 180, right? And then fell to 50 during the bear market last year and rallied to as high as 140. So great boom and bust stock. If we are going to have another leg down in the bear market, maybe the second half of this year or, whatever, Crocs will probably could go to $10, $20 a share or $30 a share. And by the way, it'd be a great buy down there, but like right now, I think this is, and it only trades at 13 times earnings, but again, it's a boom bust stock. There's no reason this stock can't trade at 5 times earnings at a bottom as well. Right. So anyhow, and then earnings will probably go down in a recession. So I like that because it's a boom bust, and also a lot of the people that shorted these stocks and bought puts on these banks, when the government came and took them over, they can't exercise their options. And places like Robinhood aren't letting them, basically exercise the puts at the specific profit because this thing's no longer trade anymore. And like, I don't even know what happened when the Russian companies all got halted. Maybe the same thing happened. So you have that as well. And then another one, like I said, KBH was another one. And like I said, I think that this little rally here that's happened in the home builders is a good opportunity to get into the short because it's happened just because interest rates have kind of, bonds have rallied, interest rates have come down. There's no fundamental reason. So that's KBH. So that's it. But anyhow, so we have these, I'm doing as hedges. And then I'm looking at stocks that are really beaten up. So for this, this is Wish. So Wish is a company similar, kind of like an Amazon type thing where they sell, clothing, consumer goods online. And I've used it. So I used to see, I'm a big Premier League fan, and I used to see the Wish on all the, the advertisement boards they have on the side of the games. So I was like, oh, I'll try this service. And I thought it was interesting. So I'm like, oh, it's a UK company, which is interesting too, because, most of these tech type companies tend to be American, And I used it, and the issue is they get everything from China, and like it's so complicated because I think a lot of I'm a big Miami Vice fan, so I like to buy like the linen suit jackets and linen and Living the Bomb as it works too, like cool linen shirts, pastels, stuff like that, and I would buy it, and a lot of the stuff was too small because it's Chinese sizes. Like for example, a large, which I am in the States, is like a 3X large in China. And it took me a while to figure that out. So I was buying all these shirts that were too small, they're a lot of their stuff is not the best of quality, it's coming from China. So they had, they had a big boom. The IPO'd at like $30 a share. They had a big boom, initially with all the advertising the Premier League. Like Wish is the advertiser for the team I like, Leeds in England. You can see it here, and it collapsed. But they have a very good balance sheet. They don't have a lot of debt. They have nearly 700 million in cash equivalents. Their revenues have basically collapsed though. Like they're down about 50% year over year. They got a new CEO late last year to kind of turn around the company. And actually, a famous short seller recently put out a buy on them, saying like because of the legit, obviously the infrastructure they have, if they can turn things around, they should do well. And like I said, because they don't have a lot of debt and they have a good amount of cash on hand, they you probably just will, you probably have to have. It's probably tough for the next year during a turnaround. And obviously, if you're in a bear market, who knows? Just go to 20 cents a share. But this is the kind of company I like. Pretty good debt, a very good balance sheet, a lot of cash, has the logistics there to kind of turn the company around. Turnaround plays are tough, right? Because we're seeing things like Bread, Breakfast, and Beyond really struggle with turning the company around. But they have a huge amount of debt, and that's why they're going to have a difficulty. So this is a stock. I really kind of like, and then, I like the 3D printers still. They had a bit of a bounce here, but same thing. You can see that's just a financial crisis. These were actually, the COVID crisis. These actually were, about like $100 a share back in 2014. But you can see they've fallen a great deal. They're down 90% because they're down 90%. Their revenues have grown in the last 8-9 years. There's been multiple compression in terms of price to sales. Most of the companies you'll see that I look for them trading at 1-to-1 price to sales or less, because price to sales, you can grow into that valuation, and then profitability can come if you can turn the company around. So these are the kind of things I'm looking for. It's like, okay, I'll look to short these other things that I mentioned earlier, and then I'll look to go long these super beaten up stocks. But I wouldn't just jump in head first. What I would do right now is the quote unquote, put your toe in the water and then put your toe in the water and then, buy a little bit of the position here. And then if it continues to go lower, kind of averaging, so you're never going to get the exact kind of bottom. And that's worked out for me in the past. Like I remember going back to Greece, one of my good trades of buying beaten up companies was HL Toy, the Greek telecom company. We're going to go back 17 years. So you can see it. You can see I remember I turned bullish here on it about 140. And it was the same thing. Kind of you average down and went almost to 50 cents. And then you can see, by early 2014, not even 2 years later, the thing was, $7 a share. So even if you bought a 140, you still made 5 times on your money. But if you average down and say got your average price down to like 1, you bought some at 50 cents, some at 140, some at 110, some at 80, whatever it is, you would have increased. So that's kind of what I'm looking at here. And there's a nice thing about this tech bust is there's a lot of companies like that who were able to raise money during the bubble. So they're cashed up, they don't have a lot of debt, and they've gotten killed. So I'll have more like that kind of wish play there. And obviously I have a lot of juniors I like. One company I'm working for right now, they don't even have they're basically, it's been frustrating because they actually have some really good drill results. You'll see I have a short interview with them today as well. So I have a marketing agreement with them, et cetera, et cetera. I only market with companies that I really like. So it's gotten whacked. It's traded pretty good volume. You can see up to this month, but I think it's excellent here at only $3.3 million market cap. You can see they have 689 meters of that's a huge long drill hole of half a gold a ton, 30 meters of 1.24. So I really think this is a company that you could buy here, and I think would turn around quite well with this low kind of market cap and valuation. This Carlisle Commodities. So I'm looking at companies like that, et cetera, as well. So I think I talked about a lot today. So you can see this is what I'm going to be doing going forward in the newsletters. I'm going to be now. I think there are actually beaten up companies. I'll talk about Fubo in the next one. That trade didn't work out last time. I think I did put an alert saying when it was in the 190s, you should get out of this thing at this point because I didn't look like it. Now it's down to 120. Fubo needs a cash injection, and of course now it's going to be difficult to raise money at these levels. That's going to be kind of their problem here. And anyhow, so you're not going to get all these right too. Like some of these turnaround plays are going to just go kaput. But the problem is, the good news is when you're doing turnaround plays, like I mentioned, Crox went from 70 to 1 in 2009. So did Las Vegas Sands, and those companies went up. Your Crox, if you had bought that in 2009, if you saw it went to 180, you'd been up 108 times in your money. So, that obviously like buying at the very bottom and selling at the very top is not realistic, but I'm just saying that's an example. And Las Vegas Sands are the same thing. You could have, if you were bought in the $1-2 range, you could have made 20 to 40x easy. So anyhow, I'm going to leave it at that. And I hope you enjoyed this video. There's going to be a lot more going forward. Thanks for bearing with me the last couple of months. But we're going to be very, very active now. And even for those of you who aren't paying members, I'm going to really start getting my Patreon going again. And then starting to do just little daily updates, be more like news type updates, kind of rants. I'm a huge fan of a guy named Kevin Brennan. He has a podcast called MLC, Misery Loves Company. It's very politically incorrect if you do want to watch it. He's on 4 p.m. every day. They read a lot of super chats from the fans. You'll see I usually pitch in with a couple super chats every day. And because I love that kind of humor. I like, I like very politically correct kind of dirty humor. And that's what those guys are like. So anyhow, so I like that ranting style and complaining style. And it's kind of a bit of my personality as well. I like to make fun of stuff. So we're going to do that and I want to have fun with it too. I think one problem with this whole financial market thing is you can get down yourself. You can say like this, like, oh, Silicon Valley, these guys are a bunch of scumbags. Their political buddies we're bailing them out, F them all, blah, blah, blah. It's easy, very easy to get jaded kind of like that. And very easy to get that way, And But anyhow, I'm gonna have some fun with it. So I think I'm about done here. I'm gonna save this, and I hope you enjoyed it. And there's gonna be a lot more of this kind of thing going forward. Thank you very much.